Hi everyone, welcome back to Chapter 9. In this video we will discuss the gross profit method of estimating inventory. For some companies or in certain situations, it becomes difficult or impossible to physically count each unit of inventory. For example, consider a large retail company that has locations over the entire nation and sells many different items. Trying to track the cost of each item would be nearly impossible. In these situations, companies have developed methods of estimating inventory. The gross profit method, also known as the gross margin method, is useful in situations where estimates of inventory are desirable. The technique is valuable in a variety of situations, including the following: in determining the cost of inventory that has been lost, stolen, or destroyed, in estimating inventory and cost of goods sold for the interim financial statements, avoiding the expense of a physical inventory count, in auditors' testing of the overall reasonableness of inventory amounts reported by clients, and in budgeting and forecasting. Let's compare the gross profit method with the way inventory and cost of goods sold normally are determined. Usually, in a periodic inventory system, ending inventory is known from a physical count, and cost of goods sold is derived as follows: beginning inventory from the accounting records plus net purchases also from the accounting records equals goods available for sale minus ending inventory from a physical count equals cost of goods sold. However, when using the gross profit method, the ending inventory is not known. Instead, the amount of sales is known, from which we can estimate cost of goods sold, and ending inventory then is a calculated amount. Beginning inventory from the accounting records plus net purchases, also from the accounting records, equals goods available for sale, less the estimated cost of goods sold equals estimated ending inventory. So the first step in estimating inventory is to estimate cost of goods sold. This estimate relies on the historical relationship between net sales, cost of goods sold, and gross profit. Gross profit, you will recall, is simply net sales minus cost of goods sold. So if we know what sales are, and if we know what percentage of net sales the gross profit is, we can fairly accurately estimate the cost of goods sold. Companies often sell products that have similar product ratios, gross profit ratios. As a result, accounting records usually provide the information necessary to estimate the cost of ending inventory, even when a physical count is impractical. Suppose a company began 2021 with inventory of $600,000, and on March 17th, a warehouse fire destroyed the entire inventory. Company records indicate that net purchases of $1,500,000 and net sales of $2 million prior to the fire. The gross profit ratio in each of the previous 3 years has been very close to 40%. This illustration shows how the company can estimate the cost of the inventory destroyed for its insurance claim. Beginning inventory from its record $600,000 plus net purchases also from the accounting records $1,500,000 equals goods available for sale of $2,100,000. Now we need to subtract the estimated cost of goods sold. Well, we know that net sales is $2 million. That came from the accounting records. We also know that historically their gross profit percentage is 40%. That means that the historical cost of goods sold percentage is 60%. 100% is the sales number, minus 60% is the cost of goods sold number, equals the gross profit percentage of 40%. So this is going to take you through a little bit of a roundabout calculation, but the basic calculation is net sales times 60% in this example will equal the estimated cost of goods sold. But let's look at their calculation. The estimated gross profit percentage is 40%, so subtracting 40% from 2 million will equal the estimated cost of goods sold. But like I said, the same way to get there is to take $2 million and multiply it times 60%. Either way, the estimated cost of goods sold is $1,200,000. Subtract that from $2,100,000 of goods available for sale, and your estimated ending inventory is $900,000. A word of caution. The gross profit method provides only an estimate. The key to obtaining good estimates is the reliability of the gross profit ratio. The ratio usually is estimated from relationships between sales and cost of goods sold. However, current relationship may differ from the past. In that case, all available information should be used to make the necessary adjustments. For example, the company may have made a change in their markup percentages for some of its products. Very often, different products have different markups. In these situations, a blanket ratio, like we used in the prior example, should not be applied across the board. The accuracy of the estimate can be improved by grouping inventory into pools of products that have similar gross profit relationships, rather than using one gross profit ratio for the entire inventory. The company's cost flow assumption should be implicitly considered when estimating the gross profit ratio. For example, if LIFO is used and the relationship between cost and selling prices changed for recent acquisitions, this would suggest a ratio different from one where average cost method was used. Another difficulty of the gross profit method is that it does not explicitly consider possible theft or spoilage of inventory. The method assumes that if the inventory was not sold, then it must be on hand at the end of the period. Suspected theft or spoilage would require an adjustment to the estimates obtained using the gross profit method. It is very important to note that the gross profit method is not acceptable for preparation of annual financial statements. Here's another concept check problem for you. The records of Oregon Timber, Inc. revealed the following information related to inventory destroyed by a fire. Inventory at the beginning of the period, from the accounting records, $900,000. Purchases to date of fire, $480,000. Net sales to date of fire, $1,350,000, and gross profit ratio 30%. Please pause your video to estimate the amount of inventory destroyed by fire Then start your video again to check your answer. The answer is $435,000. Beginning inventory of $900,000 plus purchases of $480,000 equals goods available for sale of $1,380,000, less estimated cost of goods sold of $945,000. And I got that $945,000 by taking net sales of $1,350,000 times 70% ratio for cost of goods sold. Again, if the gross profit ratio is 30%, in other words, what's left over after all the cost of goods sold is 30%, then cost of goods sold had to have been 70%. So the $1,350,000 in sales times 70% gross profit percentage, cost of goods sold percentage, equals estimated cost of goods sold of $945,000. Subtract that from goods available for sale, and you have calculated your estimated ending inventory destroyed by fire of $435,000. Well, that's all for this video. In the next video, we'll discuss the retail inventory method in estimating inventory.